Okay, let's dive right into this explainer. Today, we're stepping into the lab to put ConnectOne Bancorp through the absolute ultimate financial gauntlet. If you're someone who loves dissecting financial statements and testing out legendary investing frameworks in the real world, well, you're definitely in the right place.
So the big question driving our entire analysis today is this: how would Wall Street's absolute greatest investing legends actually value this company? We're going to put on our expert analyst hats and figure out exactly how Warren Buffett, Peter Lynch, and Benjamin Graham would view this stock at its current price tag of $32.45. Because, it's one thing to just read about their philosophies, but it's a whole different ballgame when you apply them strictly to a live, breathing corporate specimen.
Here's our roadmap for the breakdown. We'll start with a quick company snapshot, apply our three legendary lenses, Buffett, Lynch, and Graham, crunch the raw math with some quantitative models, and then pull it all together for our synthesis and verdict. All right, kicking things off with Section 1, the company snapshot. Let's isolate ConnectOne and see exactly what we're dealing with here.
ConnectOne Bancorp, trading under the ticker CNOB, is a major regional player, and they are boasting a massive $14 billion in total assets. They operate mostly in the New York metro area and Florida, with a really heavy focus on small to mid-sized businesses.
Just look at their geographical footprint. They've built up this incredibly dense, strategic presence right across the Northeast. We're talking New Jersey, New York City, Long Island, and they actually just accelerated that reach by acquiring the First of Long Island Corporation, which slapped another 36 branches onto their network. So right off the bat, we're looking at a growing, acquisition-hungry bank.
Moving right along to Section 2, the Warren Buffett lens, quality and moats.
So how does ConnectOne hold up under Buffett's famously picky standards? Well, Buffett always looks for a moat. For ConnectOne, their strategic advantage really comes from what they call a highly efficient branch-light model, plus a super disciplined M&A track record. They've proven they can absorb acquisitions fast. But honestly, what's maybe most interesting for their future scalability is that management is actively weaving artificial intelligence into their daily systems to drive efficiency. That kind of operational leverage, that is exactly the structural advantage Buffett is hunting for.
And when we run them through his strict quantitative checklist, they perform admirably. They've got consistent earnings with an operating return on equity resting really solidly between 10.4 and 11.5%. For owner earnings, which is just a classic Buffett metric, we can use their reported net income available to common stockholders, sitting at a robust $150.1 million. Combine that with remarkably low non-performing assets of just 0.29%, and yeah, Buffett's criteria are largely met here. Based purely on quality and moat, Buffett would probably stamp this as a buy, assuming the price offers a good margin of safety, of course.
Okay, Section 3, the Peter Lynch lens. Let's categorize their growth. Lynch was famous for categorizing a company's story before he ever looked at the math. So where does ConnectOne fit? Well, Lynch would likely weigh their stalwart growth traits, like that impressive 10% annualized loan growth and nearly 10% dividend growth over the last decade, against the highly cyclical risks of their heavy commercial real estate exposure. So it's kind of a hybrid. It's a steady compounder wrapped up in a highly cyclical sector.
Now, if you know Peter Lynch, you know his favorite metric is the PEG ratio, price to earnings divided by the growth rate. Since we don't have explicit forward earnings guidance in the source data, let's make a logical assumption. If we use that recent 10% annualized loan growth as a proxy for earnings growth, and we stack that against their roughly 10.8 PE multiple, we get a highly attractive PEG ratio of roughly 1.08. In Lynch's universe, anything hovering near 1.0 is a solid buy, especially for a stalwart paying out a super reliable dividend.
Which brings us to Section 4, the Benjamin Graham lens. This is all about defensive, deep value.
Graham, the godfather of value investing, only cares about tangible assets and extreme margins of safety. He literally developed a specific formula for the defensive investor. It goes like this. Intrinsic value equals the square root of 22.5 multiplied by EPS multiplied by book value per share. So if we take their officially reported $3 in earnings per share and their $23.93 in tangible book value and plug it right into Graham's exact formula, it spits out an intrinsic value of exactly $40.19.
Now, here is why that matters. With the stock currently trading around $32.45, comparing it to that $40 intrinsic value gives us a 19.2% margin of safety. Plus, they easily pass his defensive checklist for adequate size, remember, $14 billion in assets, and they have a 19-year unbroken dividend record. This places ConnectOne squarely in Graham's defensive wheelhouse. Honestly, for him, it's a definitive buy.
All right, Section 5, quantitative models. Let's put the philosophies aside for a minute and just hit this stock with raw math.
We're building out a discounted cash flow, or DCF model. To do this, we got to make some explicit assumptions. If we use their $150 million net income as our base free cash flow proxy, and apply a standard 10% discount rate, which is pretty typical for a regional bank's cost of capital, along with a really conservative 2% terminal growth rate, our base case DCF calculates a fair value near $37 per share. Notice how that's once again comfortably higher than the current trading price.
But models are really only as good as their inputs. Look at how that fair value completely swings in our sensitivity table when we tweak the math. If we demand a strict 11% return and assume only 1.5% growth, the fair value drops down to around $30. But if we loosen up the discount rate to 9% with 2.5% growth, boom, it skyrockets up to $46. Our $37 base case sits right in the middle, strongly signaling that the stock is undervalued right now.
And let's look at one more quantitative angle, the dividend discount model. We absolutely have to acknowledge their staggering 19-year history of unbroken payouts. In the volatile banking sector, that kind of consistency is rare. With a recent 8.3% dividend hike and a 9.8% 10-year growth rate, a DDM heavily supports a price floor right in the mid-30s. The cash they are returning to shareholders is just too consistent to ignore.
Okay, let's bring it home with Section 6, Synthesis and Verdict. We've seen the bull case, now we need to look at the whole picture.
We have got to be impartial here and talk about the massive $8.1 billion elephant in the room. Why is this stock so cheap? It's because ConnectOne carries $8.1 billion in commercial real estate loans. That is over 400% of their Tier 1 capital. That's well beyond standard regulatory concentration guidance. And to make things spicier, they have $2.4 billion in loans facing rate resets in 2026 and 2027. If the real estate market softens, or borrowers just can't handle the higher rates when they reset, ConnectOne's pristine asset quality could deteriorate, and fast.
But look at the synthesized data. The math is just overwhelmingly positive. Every single valuation model we ran, from Graham's deep value formula hitting $40.19 to our quantitative DCF at $37 to Lynch's PEG ratio, they all suggest the stock is trading below intrinsic value. At $32.45, the market is severely discounting the stock almost entirely because of that commercial real estate fear.
So the ultimate point I want to leave you with in this explainer is this. The frameworks of Buffett, Lynch, and Graham, they all flash green. The quantitative models, flashing green. But as an investor, you have to weigh that math against the macro reality. Does a 19% margin of safety actually justify taking on a bank with 434% commercial real estate exposure right before a massive wave of rate resets? That's the question you've got to answer for yourself before pulling the trigger on ConnectOne. Thanks for joining me in the lab today, and keep on learning.